In 2022, millions of retirees opened their brokerage accounts and found their income had been cut nearly in half overnight. They had not made a bad decision that morning. They had made their decision years, sometimes decades earlier. And the stock they had trusted with their retirement was AT&T, the phone company that felt as permanent as electricity or running water. This is the story of how AT&T built one of the most trusted dividend reputations in American history and then systematically destroyed it. For most of its modern history, AT&T was considered the gold standard of income stocks. It was one of the most widely held stocks in America, sitting in pension funds, retirement accounts, and personal portfolios across the country. The yield hovered around 6 to 7%, far above what any bank account offered. For retirees living on fixed income, that yield was not just attractive, it felt like a lifeline. But behind the reliable checks, AT&T was quietly making decisions that would eventually make the dividend impossible to sustain. It started with ambition. AT&T decided it no longer wanted to be just a phone company. In 2015, it acquired DirecTV for $49 billion. Then, in 2018, it acquired Time Warner for $85 billion more. Together, those two deals added over $160 billion in debt to AT&T's balance sheet. That made AT&T one of the most indebted companies in the entire world. And yet, the dividend kept being paid. Quarter after quarter, the check arrived, and investors saw no reason to worry. This is one of the most dangerous moments in dividend investing, when the check keeps coming, but the business is quietly breaking. The streaming wars were not going the way AT&T had planned. DirecTV was losing subscribers every single quarter as people cut their cable, and the debt from both acquisitions was consuming enormous amounts of cash every single year. In May 2021, AT&T announced it would spin off Warner Media and merge it with Discovery. The spin-off meant AT&T would have less revenue going forward. Less revenue meant the old dividend level was no longer supportable. In February 2022, AT&T officially confirmed what the market had already begun to suspect. The quarterly dividend would be cut from 52 cents per share to 27.75 cents. That was a cut of nearly 47%. Almost half of every retiree's AT&T income gone in a single announcement. And the stock price fell alongside the dividend cut, compounding the damage for anyone holding shares. The double punch that dividend trap victims always face: income down and savings down at exactly the same moment. Now Penny investigates the warning signs that were hiding in plain sight the entire time. Warning sign 1. The debt load was visible and enormous from the moment the acquisitions were announced. $160 billion of debt does not hide. It is reported every single quarter in plain numbers. Warning sign 2. The payout ratio had been dangerously high for years before the cut. AT&T was paying out nearly all of its free cash flow in dividends, leaving almost no margin for error. Warning sign 3. The core business strategy was visibly failing well before the dividend was cut. Streaming was not working, satellite TV was dying, and the debt was eating the company from the inside. Any one of those three problems alone should have prompted a serious review of whether AT&T could sustain its dividend. All three together should have been an unmistakable alarm. But millions of investors never looked because the name AT&T felt safe enough on its own. A familiar name is not a financial analysis. The three questions every investor should have asked before trusting AT&T with their retirement income. 1. Can this company actually afford its dividend based on free cash flow, not just reported earnings? 2. Is the company's core strategy working, or is it making expensive bets in businesses it does not understand? 3. Is the debt level manageable, Or is it so large that one bad year could force a dividend cut? AT&T in 2018 would have scored 3 red marks on that checklist, and that score alone should have been enough. Ask the 3 questions, every stock, every time. See you next time, dividend friends.